Good day. This is the last session on the cost of capital, and here we are taking one step further on the assumptions that we made in the very first session, and we are releasing some of those assumptions that we made to calculate the marginal cost of capital. So what is the marginal cost of capital? And you'll remember in the very first session we said one of the assumptions that we're making is that the risk structure of the business and also the cost structure of the business does not significantly change, because that was one of the assumptions that we made. But in real life, the weighted average cost of capital will increase because of additional funding that we require. So as we access more funding from our various sources, the cost of those sources do increase. Why would that be? Let's look at the bank, for instance. As the exposure of a company increases at the bank and they take out more and more debt, the company assesses the risk, and based on the increased risk, the bank will then come back to the company with an offer of a higher rate. And this is then impacting on the weighted average cost of capital, because the cost of debt now increases. So the change in WACC is called the weighted marginal cost of capital, which is the incremental cost because of increasing our funding. Before we can get to analyzing the marginal cost of capital, we first need to understand breakpoints. So what are breakpoints? Those are levels at which we are reaching the maximum or the current capacity of various sources of our funding, and once we reach that, there's a breakpoint because the price then increases, the cost of that specific source then increases. So let's use retained earnings, for instance, the first example, and we've got available 250,000 of retained earnings. If we're only using 50,000 of that retained earnings, the cost is the current cost of retained earnings. But as we increase our requirements on funding and we reach or we deplete our retained earnings, we need to issue new shares, and as we issue new shares, the cost of our equity portion in our weighted average cost of capital then increase. So how do we calculate a breakpoint? In our example here, we're saying we've got 250,000 available in retained earnings, and equity is 50% of our funding. So we take the 250 divided by the 50%, or 0.5, depending on what your preference is, and that says because retained earnings is 50%, our breakpoint and our total funding is at a level of 500,000. So as soon as we reach 500,000 Rand of funding, then we will need to, or our weighted average cost of capital is going to change, because equity or retained earnings is half of that, and that is determining where that breakpoint is. The second breakpoint is then calculated, let's say debt, for instance. Debt, we have available facilities of 450,000, but debt is only 30% of our cost of our capital, and therefore it is 450 divided by 30%, and that tells us the next breakpoint will be at 1.5 million Rand total funding. So let's put this in a table. The first section on the table, calculating the weighted average cost of capital of 10%, is the current scenario. So that is while we're inside our 250,000 of retained earnings and within the 400,000 Rand of debt. And we do the normal calculation in weighted average cost of capital as we did in session 5. and that gives us the 10%. But there's a breakpoint that we just calculated at 500,000. So our total funding, as soon as we increase our total funding beyond 500,000, so between 500,000 and 1.5 million, our cost of equity increases because we need to issue new shares. And there you see the only, and that's where the arrow is, the only change between the second and the first section is the cost of equity that now increases from 12% to 14%. That brings the contribution from 6% to 7%, and the weighted average cost of capital total then 11%. That means we require more return for projects when our total funding is between 500 and 1.5 million rand. The last breakpoint is then at 1.5 million, and that's what we calculated, and that was based on debt, because we have debt facilities. We now reach the facilities limit and we need to request further debt, and the bank comes back and says, but your risk is increased, therefore you need to pay a higher price for the additional risk that we as a bank taking. And there the change is, so we retain the equity at 14%, no changes, the only change is where the arrow is, and the cost of debt now increases from 6% to 10%. Remember, this is after tax cost, so it increases from 6% to 10%. That brings the contribution from 1.8% to 3%, and our weighted average cost of capital further increase. So you can see there's a step in the weighted average cost of capital from 10% to 11% to 12.2%. So let's put it in a bit of a visual environment. At the bottom line represents the weighted average cost of capital. You'll remember it was 10%, then 11%, and it ended up at 12.2%. But let's also assume that we've got investment opportunities in our business, and those opportunities are then ranked from the most lucrative. And how do we determine the most lucrative? Those are based on the internal rate of return. So project 2 has got an internal rate of return of 20%, 3 of 18%, and so they come down until we've got project 5 with an internal rate of return of 11%. If we then put these two on the same graph, then we see that project 2, 3, 1 and 4 exceeds the internal rate of return, exceeds the weighted average cost of capital, or the weighted marginal cost of capital in this example. But as soon as we move to project 5, it is below the weighted marginal cost of capital, and therefore project 5 should not be engaged. But all the other projects are lucrative and profitable, and they are available to be taken up. The big question now is, can we do all of them? And as an entrepreneur, you would say, for sure we need to do all of them. The reality is, in business, let's assume all 4 of these projects require input from the sales and marketing, but specifically the sales department. Systems that we're replacing, it's business processes that we're changing, it is a financial system that we're changing that changes our quoting system, etc. And all these 4 projects now require input from the sales department. The sales manager will push back and say, we cannot, although the company's got the money and can afford this, and it makes financial sense to do this, we as a department can't do this, because our sales team's whole day will be spent on projects and preparing inputs to projects and working with project teams, and they will not be making any sales. So there are other external as well as internal factors that we need to consider outside only the financial aspect of a project. So that brings us to the end of the marginal cost of capital, and it's also the last session on the cost of capital.